Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. Today, we're diving deep into sources from Bloomberg, CNBC, Yahoo Finance. And honestly, it feels like we're looking at a market being pulled in two completely different directions.
It really does.
You've got this almost unstoppable momentum behind artificial intelligence investment, huge sums of money. But then on the other hand, there's this really tough global trade environment, tariffs impacting what you might call the real economy.
Yeah, it's this striking dual reality, isn't it? And it really demands our focus today. You have literally trillions potentially flowing into tech that promises to reshape everything. Valuations are sky high in that space.
Astronomical.
But at the very same time, you look at parts of the, let's call it the old economy, traditional industries, manufacturing, and some are putting up surprisingly strong results. Despite inflation still being sticky, despite all the geopolitical messiness.
So our mission today is really to try and cut through that noise, figure out which narrative, holds more weight for your portfolio right now.
Sounds good.
Okay, let's start with AI then. The high-stakes world of artificial intelligence, because some of these potential deals are just, well, they're staggering. We saw this massive development reported by Bloomberg. It involves Anthropic PBC, that really high-profile AI startup. They're talking to Alphabet, Google, about a cloud computing deal. And this isn't for software. It's just for the raw computing power they need.
Built for the models.
Exactly. And the value, we're hearing high tens of billions of dollars.
Wow. Yeah, that's more than just a big purchase. It's a colossal commitment to infrastructure. And it really puts Anthropic's rapid rise into perspective, doesn't it? They just closed that $13 billion funding round.
Which nearly tripled their valuation, right? To something like $183 billion.
An absolutely breathtaking $183 billion. And remember, Google already put in $3 billion before this. Amazon's committed $8 billion. They're both crucial cloud partners.
And the market noticed. Google shares popped. What was it?
Over 3.5% in extended trading. Meanwhile, Amazon, probably seeing the competition heating up for Anthropic's business, slipped about 2%.
Okay, wait, though. If this deal is high, tens of billions, and it's mostly an expense, right, for computing power, how much of that $183 billion valuation is based on, actual revenue down the line versus just the sheer cost of playing the game?
That right there is the multi-billion-dollar question, or maybe trillion-dollar question now.
Maybe.
Because that valuation is absolutely based on future hoax, not current cash flow. And that leads us perfectly to the next big topic, the one CNBC covered extensively. Are we actually in an AI bubble?
The big debate.
And experts are really divided. You have the pro-bubble camp, like analysts at Bernstein. They point to these extreme valuations, the surging asset prices, classic bubble signs, they say. They used OpenAI as a prime example. You have, something like $1 trillion in potential deals, including that maybe $500 billion data center build-out.
Huge.
Compared to maybe $13 billion in expected revenue. That gap, that massive chasm between the investment needed and the credible near-term profit potential, well, it looks pretty bubbly.
But then you have Larry Fink, BlackRock CEO, pushing back hard. He doesn't see a bubble, he sees
necessary investment, capital expenditure, basically.
Right.
Fink's argument is, look, this isn't just speculation that'll vanish. It's the required spending on the fundamental building blocks for the U.S. to stay ahead globally, technologically, and economically. He stresses it's not just chips. It's money going into IT, into cooling systems, HVAC, into upgrading power grids, power supplies for these monster data centers. It's industrial capacity investment.
But he's realistic too, right? He acknowledges there will be winners and losers.
Well, absolutely. He says that is capitalism. Yeah. Pretty blunt.
And then there are the folks taking the longer view. Like Gelsinger believes we are in a bubble, but maybe an early stage one that won't pop for years.
Exactly. It gives you that crucial historical perspective. Howard Marks, another veteran investor, says he hasn't seen that critical mass of mania just yet. He often compares it to the late 90s internet boom. It was definitely a bubble. Tons of companies went bust.
For sure. Pets.com.
Right. But the underlying technology, the internet itself, fundamentally changed everything. It became the platform for global business. So the big question is, will AI be that fundamental?
A fascinating question. Okay, let's pivot from the future tech, maybe, back to the here and now. The corporate report card. Jim Cramer was arguing recently that the Dow's record wasn't just about the Magnificent Seven tech stocks.
Yeah, he's always focused on those underlying fundamentals. He argued we need to give credit to the strength in the, quote, real economy. We did see some really strong earnings from companies not directly tied to AI chips, GE Aerospace, RTX, 3M, even Coca-Cola.
Solid results.
Yeah, they all delivered numbers suggesting things are pretty robust operationally. Outside that tech concentration, that's what's supporting the broader market, he argues.
Okay, let's drill down into a couple of sectors. How about banking over in Europe? CNBC covered Barclays Q3.
Barclays actually had a surprisingly good quarter. They beat their guidance, which is always good.
And a buyback.
Yes, a surprise, $500 million, what's that, about $667 million share buyback. And importantly, they bumped up their guidance for ROTE.
Okay, remind us quickly, ROTE, return on tangible equity. Why is that so critical for a bank?
Right. ROTE basically measures how well a bank uses its shareholders' money to make profit. Hitting over 11% for the full year, which is their new guidance, signals really solid financial health and good management.
But it wasn't all smooth sailing.
No, there was a hurdle. Their overall pre-tax profit was actually a bit below what analysts expected, mainly because of a pretty big $235 million charge tied to that ongoing UK car loan scandal.
Ah, okay, so a strong operational performance kind of overshadowed by a legacy issue.
Exactly. A regulatory hangover, you could say.
All right, let's swing over to the consumer side. The streaming giant, Netflix, took a bit of a tumble. Yahoo Finance and CNBC both covered their Q3, missed on earnings and profit.
Yeah, the stock dropped, I think, over 6% pre-market. But this is a classic case of a headline miss caused by something outside the core business.
Not subscriber numbers or anything.
No, revenue was actually fine, right in line. Subscriber growth was decent, too. The problem was this huge, unexpected $619 million expense.
Wow, what was that from?
An ongoing tax fight in Brazil. A big one-off hit.
But the underlying business health seems okay.
It looked pretty strong, actually. They had their best quarter ever for ad sales. That's key for their future growth plan. And content-wise, huge success. That animated film, K-pop Demon Hunters, became their most viewed movie ever, 325 million views.
Incredible.
So yeah, the stock dipped on the headline number, but operationally they seem to be executing pretty well on that shift towards ads and cracking down on password sharing.
But consumer struggles are real, and that leads us nicely into the next point. Mattel's Q3 miss, also noted by CNBC, shows how these bigger forces hit everyday products.
Yeah, it's a perfect example of geopolitics affecting the price of, well, a Barbie doll. Mattel missed on revenue and earnings per share.
Why?
Mainly because global sales for Barbie and Fisher-Price dropped by double digits. The CEO pointed to two things: changes in how retailers are ordering across the industry and those ongoing global tariffs. Specifically said they're really hurting North American sales. You just can't escape the costs of a trade war, even selling toys.
And that pain Mattel's feeling from tariffs is a great segue into the broader picture. Global trade and these tariff tussles. We're seeing some big geopolitical plays trying to reshape these supply chains. One really interesting development from CNBC's reporting is this potential major trade deal between the U.S. and India. It seems close.
Yeah, this could be huge, and it directly links trade policy with diplomacy. The deal might involve the U.S. slashing tariffs on certain Indian exports down to maybe 15 or 16%.
Which is way down from, what, 50% currently on some things?
Exactly, a dramatic cut. But the key geopolitical piece is that India might, in return, agree to slowly reduce its reliance on Russian oil imports. That oil dependence has been a major sticking point, right? It led the previous administration to slap on that extra 25% penalty tariff. So this isn't just about goods, it's using trade as a strategic lever.
And speaking of existing tariffs, let's look at China. Bloomberg had an analysis on how resilient their supply chain still seems, despite years of high U.S. tariffs.
It's quite remarkable how the sheer volume keeps up. About $1 billion worth of goods still cross from China to the U.S. every single day. It even ticked up a bit in September.
How is that possible with the tariffs?
Well, part of it is China's dominance in certain essential areas like rare earth minerals. U.S. tariffs just have limited bite there. But companies have also gotten, let's say, creative. They're finding loopholes.
Clever loopholes. Or maybe slightly dodgy ones.
Maybe a bit of both. The two main methods seem to be transshipping and playing with customs valuations.
Okay, explain transshipping.
So instead of shipping a finished product straight from China to the U.S. and paying the full tariff, an importer might ship it to, say, Vietnam or Mexico first. They might do some minor final assembly there, then ship it to the U.S. claiming it's a Vietnamese or Mexican product, dodging the China tariff.
Then the customs valuation trick?
That involves underdeclaring the value of the goods based on an earlier sale in a third country It's sometimes called the first sale rule. It basically lowers the base value the tariff is calculated on.
So loopholes exist, but is actual decoupling moving manufacturing out of China really happening, or is it just talk?
Oh, no, it's definitely happening. But it's very targeted. Bloomberg pointed to clear evidence for specific products. Think game consoles, Nintendo, Microsoft moving production heavily to Vietnam. Exports of those from China just collapsed. Same with LCD TVs, a 73% drop in exports from China.
Wow.
So the bulky, lower margin assembly work, that's moving. But the really complex, high-tech stuff, those supply chains are proving much harder to untangle from China.
Okay, let's shift gears again to the macro picture. Connecting this globally, we had that UK inflation puzzle, right? Reported by CNBC.
Yeah, the data came in a bit cooler than expected. UK inflation was unchanged at 3.8% in September. The Bank of England had forecast 4%.
Which sounds like a small difference, but in central banking terms.
It's significant. It immediately raised the question, does this put a November rate cut back on the table?
And the answer is?
Probably not. Analysts reckon that possibility is hanging by a thread because the broader economic picture is still pretty murky. August GDP growth was tiny, just 0.1%, and underlying inflation, even with that slightly cooler headline number, is still proving sticky. So markets are actually pricing in fewer future cuts now than they were just a few weeks ago. The Bank of England doesn't have much room to maneuver.
Meanwhile, back in the U.S. markets, we saw some wild swings in precious metals. Yahoo Finance and Bloomberg reported gold and silver took a nosedive.
Yeah, steepest sell-offs in years, apparently. Gold dropped as much as 6.3% just on Tuesday.
Why the sudden plunge?
It seems mostly technical. Traders were taking profits. The charts, the technical indicators, were basically screaming that the metals had rallied too far too fast. They were trading in what's called overbought territory since early September.
Okay, overbought territory just means the price shot up mainly on momentum, signaling a correction was likely?
Pretty much. The price got ahead of itself, suggesting a pullback was overdue. The initial rally was fueled by a couple of things. That debasement trade idea.
Which is basically a hedge against governments printing money or running up huge debts, weakening the currency.
Exactly. That plus earlier hopes for quick interest rate cuts. When those rate cut hopes faded a bit and the technical charts looked stretched, the selling started.
And what's making it even trickier for investors in that space right now?
Well, the market's kind of flying blind on positioning data. Because of the government shutdown, we're missing the weekly CFTC report, the Commitment of Traders report.
And that's important because
it shows where the big players, the institutional money, are placing their bets in the futures market for gold and silver. Without that transparency, traders are reacting more to just technical signals and pure sentiment, which can definitely amplify the volatility.
Okay, so let's try and bring all these threads together. Connecting that relentless AI investment back to the consumer hardware race, because that seems like the next big battleground for applying all this superintelligence.
Right.
CNBC covered Samsung launching their Galaxy XR headset. It's $1,800, clearly aimed right at Apple's Vision Pro.
Direct competitor.
But the key difference they're highlighting isn't just the specs, it's the deep, immediate integration of Google's Gemini AI assistant. They're pitching it as a stepping stone to future, smaller AI glasses.
And that AI integration is meant to be the wow factor, right? Letting you organize virtual stuff, generate content instantly, interact with the real world through the headset in new ways.
Sounds impressive in a demo.
Absolutely. But here's where the AI risk meets the consumer market directly, and why it matters for you. To do those advanced generative things, Gemini relies heavily on cloud processing, which means to get those cool features, you, the user, have to constantly send data back to Google servers.
Which immediately raises huge privacy questions.
Precisely. That constant data transmission is a major privacy red flag for a lot of people, especially when you compare it to Apple's approach, which emphasizes doing as much processing on the device as possible.
So that cloud reliance could be a real barrier to adoption.
It really could. It might be a non-starter for many potential buyers. The risk here isn't just about the money invested, it's ethical and personal.
So wrapping this up, we've got this picture of almost reckless amounts of money pouring into AI that's still unproven, often cloud-reliant, juxtaposed against a real economy that's grappling with the very tangible, immediate costs of trade wars and inflation that just won't quit.
So if you step back and look at the whole landscape, you really have to ask yourself, in a world where trillions are bet on developing superintelligence and global supply chains are fundamentally shifting, which risk is actually greater for you as an investor, as a consumer, Is it the short-term turbulence of tariffs, inflation, market swings? Or is it the much longer-term, maybe even existential, ethical, and financial risks tied up in creating these powerful, deeply integrated AI technologies?
That is definitely something for you to mull over as you start your day. Thank you for joining us for this deep dive into the latest financial headlines. We'll see you all tomorrow morning with new headlines from major financial magazines.